Good morning, good afternoon, everyone. Well, let's kick off. Again, good morning, good afternoon, everyone from all over the world. My name is Theodore Shaw, Chief Investment Officer of Skybound Capital Group. Today, we are having another session of macro landscape. We are going to give you a tour of the world. But let me introduce you our dear guest, Jabir, from our London office. Jabir is the Chief Strategist of Skybound Group. In the past sessions, you must have listened to Jabir and myself insights into global economy. But today is a very, very different day because after a few years of rate hike cycles, we previously have seen some of the developed economies starting cutting rates. But the biggest move anticipated is from the Fed. And yesterday, Fed dropped the bomb. Now, the market was already anticipating or pricing fully that Fed was going to cut rate. The only difference was whether it was a 25 bips cut or a 50 bips cut. I think the move Fed took yesterday surprised at least half of the people. Now, my question to Jabir is, did that 50 bips cut surprise you? Were you in the 25 bip camp or the 50 bip camp?
Yeah, thanks, Theo. Good morning, good afternoon, everyone, wherever you are. Um, it's a great question to kick off with because until a week ago, I would have said yes. I would have been very surprised. In fact, it would have had me concerned because it's a case of what is the Fed seeing that we're not seeing. And then during the course of this week, in getting my slides ready for this presentation, it suddenly occurred to me what they might be doing, what I think is the ulterior motive, which I'm going to focus on in this presentation. I see one big wall out there, and I think they have started to prep themselves and the markets and the economy now. And they had to do it by kicking off with a very sizable cut. Um, so on that cue, if you like, I mean, I'm quite happy to go into the presentation for the first bit. And let me
Please
let
do.
me just start to share some thoughts here. Um, just going to call this up. When you can see it, just give me a shout. Um,
Yeah, it's
you
coming
got it.
through.
Okay,
We can
perfect.
see it.
So great. So what I'm going to do is just kick off with a little bit of backdrop, some context as to what's been going on. In the Northern Hemisphere, August is a classic holiday month. So imagine you've gone away for holiday with family, and you come back and you think, and you look at your portfolios, and you think, oh, lovely, the holiday's been paid for. It was a lovely month. By and large, depending on whichever asset class style you look at, the stock markets, fixed income, you've made money. You've made anywhere between 1% and 2%, with some exceptions. You would have thought that it was a nice, smooth month. The reality was that it was quite different. It was actually quite different, and all for one particular week of it, peaking as measured by the volatility index, or the VIX for short, peaking on 5th of August. Now, as a rough idea, when the VIX index is at or below 20, it's generally okay. And the lower it is, the better it is. And you can see it's had some incredibly low moments there. When it goes 30 or above, that's when you're hitting some deep water. And if I was to do a maximum graph here, in 2008, it nearly hit 80, give or take. In 2011, it hit about the same level, 40, and COVID as well. It was around a similar sort of mark. So there was some real frenzy. Um, what caused this? Well, this is actually the main reason for it. Again, it came down to the job scenario. Now, there's one indicator, and it's about as current as you can get. It's called the weekly jobless claims number. Um, and that, going back for 5 years, has been really consistent. In other words, a sign of a very strong, healthy labor market. It's the rate at which companies lay off workers. Essentially, it's people filing for unemployment. And when you home in at the end bit here, you'll start to see what actually gave rise to it, because on 3rd of August, the weekly jobless number peaked. So it had been steadily ticking up. There had been concern, but it peaked there. And that tipped the scale. And that's what caused the frenzy. Eventually, it started to correct itself. So in Trump style fashion, fake news, arguably, that kind of stuff. It's not fake. It was a question of being patient here. There was a correction. Remember, August is notorious as a holiday month. You get distortions in the labor market. It's very dangerous to infer anything from that. Um, there's another factor that came into play, and you probably heard this being mentioned in the press. It's this SAM rule, or SAM rule. This is named after a lady called Claudia Sam, who used to head up a unit at the Fed. She's a very good economist, and she devised this rule, the SAM rule. And essentially what it does, and it's shown there graphically, is it takes the 3-month moving average of the unemployment rate. So in other words, it's recalculated every 90 days. They then subtract the last 12-month low, which in this instance was here. And that difference, if it's greater than or equal to 0.5%, which as demonstrated by the dotted line there, implies that you have now entered a recession. And this really spooked markets, because if you look at the upward trend here, clearly it began to worry people, and they saw this coming. Now this is, the stats, the way of measuring this thing is not bad. I mean, it's got a good track record. It's showing here, but this is a classic example of the present being so different to the past. I think there are so many instances where people have not actually considered how markets have changed, how things have changed culturally, how things have changed structurally. And I follow Claudia Sam on LinkedIn, in fact, and just 2 or 3 days ago, even she said that although the rule has been triggered, she does not believe that we're in a recession. She actually said that categorically. So this is one of the dangers of people rigidly following rules. Another classic example, which we've had in the past, is this thing called the inverted yield curve. And what people say is that if you take the difference between the long end bond market, the 10-year typically, and you subtract the short end bond market, typically 2-year, that difference, if that becomes negative, then you have an inverted curve. And if you have an inverted curve, that implies you've got a recession. Now, it is true in history, in economic history, that every recession has indeed been preceded by an inverted yield curve. But I'm afraid the converse is not true. So it's one of those things where, on balance, it suggests that something could be happening. Think of it as a guidance tool, but when people start to follow it and swear by it, that's when the dangers arise. So now we go into September. And again, it kicks off with jobs. This time it's the number of job openings, which have steadily been declining. 7.673 million job openings is still impressive, but it's come down from the heights which were triggered very much by COVID. But that wasn't the only thing in September. You had some extra factors at play here, none of which had anything to do with fundamentals. And it's shown there on the right-hand side. NVIDIA, there was an alleged probe into NVIDIA for antitrust violations by the Department of Justice. And, most of you, I think, will know this is the darling of the stock market right now. Some would sort of tongue-in-cheek say it is the stock market. Then you have another chip maker, Supermicro. There was a short report released by a boutique fund, Hindenburg Research, suggesting that it's time to short this. And it happened to coincide with a delayed filing of the company accounts. So that aggravated matters even more. and their stock price plunged. Then you had weakness displayed in activity numbers as measured by PMIs, Purchasing Managers Index. I'll come on to that. I've got a slide on that. You then had the geopolitics. In Germany, we had big gains by the far right, and indeed by the far left. That has spooked people. Last but not least, the continuing story around China. It's slowing. The government doesn't seem to be doing much. And even what it's doing doesn't seem to be really paying off. This is a worrying factor for the rest of the globe. So, what does it mean? I mean, basically, when you look at all of this, markets were very much spooked into thinking that the Fed is overcooked things. And the one that worried them the most was this one here. It's the actual Fed interest rate levels, the Fed funds rate. Because when you extrapolate backwards and you take where the Fed funds rate is as of yesterday, just before the Fed cut it, and calculate what the probability of recession is that's implied. So it's a bit like, think of it like a betting market. You know, if you in the lead up to a general election, the bookies will give you odds on who they think is going to win the election, and from those odds they can extrapolate. They do using regression analysis. They can figure out what the percentage probabilities are of a particular government winning, or the formation of the new government. That's kind of what's happening here. If you look at markets as one giant betting shop, one giant casino, that's what's happening here. They take the price of the Fed funds as measured by an instrument called futures. From that price, they're able to work backwards and say, what are markets implying in terms of the probability of a recession starting in the next 1 year? And this hit 93%. And it was basically mayhem. If you look at some of the others, I mentioned the inverted yield curve. That's this one here. That's the 10-year minus the 2-year, showing 31%. Also high, but much lower than it has been. Here's an interesting one, the MBS spread. MBS stands for mortgage-backed securities. The lower the spread, the less perceived risk. And based on that, there was only a 3% probability being given based on the mortgage market that there would be a recession. And who's in the mortgage market? It's the consumer. And what does the consumer make up of the US economy? 70% of its GDP. So the irony here is that the one factor that really matters was being given an incredibly low probability of recession. But based on these two, especially this one, they were suddenly saying the Fed's overcooked it. It's going to be mayhem.
Okay, so how bad exactly is it though? Um, this is not just a question from myself. I believe a lot of our attendees have a very similar question. Here, I welcome everyone to post their questions, if any, into the Q&A box so that we can see them, and we definitely will address them when Jabir finishes this particular session. Thanks, Jabir. How bad
Yeah.
is it? Are we looking at something that we should be worrying about?
So yes, there is, and it's further down the line, and I'm going to cover that. I am surprised that it's not being given the level of attention that it deserves. But I think the move we saw from the Fed yesterday had very little to do with fundamentals. It certainly, to my mind, has nothing to do with the factors that I've referred to. Because in actual fact, look at the job market. You have to split it between two areas. You've got the supply side, which I'm just going to call S. That's what I showed earlier. That's the number of people entering the job market. It is a fact. Goldman Sachs did a very good study into immigration and migrants coming into the workplace. And they did this based on migrants coming into the country and then looking at court cases when they appeal, for instance. And from that, from a very sizable number, they were able to make some quite impressive deductions. And, you know, at one stage, you had something like 350,000 workers joining the market per month. So that's now died down considerably. We're now reaching a normal kind of level. But the supply side picture is very different to the actual picture. And this to me is a very significant chart because it shows to what extent companies are actually laying off and discharging their workers. And look at it. I mean, it's really low. This has been the latest trend here. Pre-COVID, the line was, if I can draw this straight, was a sorry, it's gone a bit above. But anyway, that was the gap. Companies are not laying off their workers. They're trying to hold on to who they've got. The push is coming from the supply side. So there is an argument that with all these people coming into the labor market, um, you know, this is going to pose a real threat to the jobs sector. I don't think it is. There is a risk of it, but it's not a big enough risk to my mind. So I don't see an issue with the jobs market. Also, don't forget that, as I said earlier, a lot of this has happened over the summer months, which in the northern hemisphere is July, August. So it's notorious for distortions. We won't really find the true picture until we start to hit the September data, and then carrying on from there. And then you get distortions again when you get into Christmas because of the temporary workers and so on. All of this plays a part. Activity data. I mentioned earlier the PMI numbers. Now, PMI is split in two parts. That's why I haven't bothered showing the composite. It's made up of manufacturing and it's made up of services. Manufacturing looks pretty bleak. You know, you've got China on the mark at 50. So anything above 50 is expansion. Anything below 50 is contraction. For Europe and US, it's not looking good, right? I mean, it's looking pretty dull actually. And this chart here shows that again, over the summer months, there has been a decline in the number of job numbers, the employment numbers for manufacturing and indeed for services. On the right, you have services which are still in expansion mode, anything over 50. Now, people tend to overlook something critical here, and that is in Europe, manufacturing is heavily skewed by Germany. And we can talk about that later if this is an area of interest. There have been some very specific factors that have affected Germany. And for the other bigger DMs like US, UK, etc., manufacturing is not a big portion of their economy. Services is. Manufacturing in the UK and US is give or take 10%, you know, plus or minus 2%. It's not a sizable share. These are big import nations. So the fact that China is just about holding up here on the manufacturing scene um, tells me that they are, amongst other exporters, feeding the appetites of the likes of the US and the UK and other parts of Europe because they have a very healthy appetite for services. What is services? It's anything that doesn't involve manufacturing an object. Services is like legal profession, accountancy profession, you know, getting your nails done, hairdressers, etc., etc. That's services.
And
It's a big chunky
including the
part.
webinar that we are having now. That is
Exactly.
service too.
Absolutely. So I think we've got some financial advisors on the call or financial advisory firms. That's exactly an example. There was a time when, I mean, just think about the lifestyle change here. A financial advisor, once upon a time, would go and drive out and meet a client all the time, right? So if you think about that value chain, you need a car. You got to fill it up with petrol. You're probably going to stop at a service station, maybe, and buy yourself a sandwich. And then you go to the clients. Now, a lot of that has been replaced by webinars. So what do? You just walk to your desk, you switch on your computer, sign into the webinar, and you're cutting out a lot of the physical items. You maybe don't need as many cars. I mean, it's a simplified example, but you can see where I'm going with this. Sometimes you're cutting out a lot of the physical stuff and you're replacing it with a service-based approach. So, you know, things have changed, and I think they've been changing for so long now, especially over the last 10 years, that it's now become very noticeable. Um,
Yep.
So I've kind
So,
of, yeah.
yeah, I'm definitely with you. I think when it comes to manufacturing, perhaps the major economies that matter are China and Germany,
Mm,
whereas services play a so much bigger role with most of the other economies.
mm,
But then we were looking at the past, right? I'm very sure many of our audience on the call will care more about the future.
mm.
What are the implications on this move on both the economy itself as well as the markets?
Yeah. Yeah, exactly. And this actually now leads me into directly what happened yesterday with the Fed, and also what I think is driving the real reason why the Fed is embarking on a rate cutting mission. Um, I said earlier that the consumer is 70% of US GDP. So I'm gonna just stick with the US for a moment, given that we are dealing with a massive Fed rate cut yesterday. Let's start with the consumer and particularly the mortgage market. This is a lovely chart. It shows how the interest rate, the mortgage rate that households pay has changed over the years. And it goes back to 2013. Today, still 90% of US households that have a mortgage are paying a rate below 6%. Now, look at the very bottom end here. Those paying less than 3% hasn't changed much. It's now 22% from just under 25%. So that's this bit here. Anyone who has a 3% mortgage, even if they want to move, will do their very best to stay put. And that's what realtors, we call them real estate agents, realtors in America are reporting that. They're saying people are not budging. Why would you? If you have a mortgage of 100,000, 200,000, and you're paying less than 3%, your cash flow, your outgoings are clearly defined every month. And that's a gift. It's an absolute gift. Hang on to it. Only move if you have to, which means going to this end of the spectrum, you can see this has expanded. And that's because certain mortgages come up for renewal. They reach the end of their time. Plus, there are people who have to move, and these guys are paying a lot more. And then in between, you have not much massive change, to be honest. So overall, I don't think this is the problem area. I don't think the Fed has done this with the consumer in mind. That's the first point to make. So where is the potential problem child? And this is the bit that has made me change my view and why yesterday I really thought there's a good chance the Fed would cut by 50 basis points, 0.5%. Let's look at corporate refinancing. It's some people call it the corporate maturity wall that's coming up. As of the 1st of January this year, this visual is showing that there was 2 trillion of corporate debt maturing over the next 12 months. In other words, by the end of this year. By the end of next year, that rises to 4.5 trillion. These are big numbers. And by the end of year after next, it hits 7.3 trillion. Within that, look at the speculative grade share. What that means is anything that's not rated investment grade is basically considered speculative. Some call it junk. There's, specifically high yield, leverage loans, anything that's speculative. That rises. You go from 12 to 17 and then to 20. These guys are already paying high rates. And then regionally, look at the breakdown. The US dominates consistently 41, 42, 44. So you can do the maths here. 41% of 2 trillion is about 800 billion. So now let's home in to the US portion and see how that breaks down over the next few years. And this chart shows it. This was a separate study done by Goldman Sachs. And I said 800 billion, and there it is. Spot on. 2024 for this year, 800 billion, and only a little bit is considered non-investment grade. It's made up of leverage loans and high yield. These naturally attract a lot of very high interest rates. Then it jumps. Then it goes up even more. These 2 years are the critical years, especially next year. If you look at the breakdown of those loans and what rates were paid, then let's start with the investment grade portion. Investment grade, because it's good quality risk, banks tend to lend at a lower rate. That's normal. So what ICI gets is quite different to a company right down at the other end of the scale. And it shows that some companies have been paying, really low rates. It's saying that if these guys were to refinance right now, then they're going to end up paying roughly 1.5% more on their interest rates. Now, there are obviously ways that they can mitigate that risk. They can hedge their interest rates. They can use swaps. They can use these kind of instruments. They can do various things. But right now, ignoring all of that, if they were to refinance right now, they're going to end up paying 1.5% more. Excuse me. On the left-hand side, you have a more worrying picture. So you've got the high yield bonds. These are not investment grade. If they refinance and look at the rates that they're paying at this end of the scale, it's huge. If they refinance, they're going to pay 2% more. Now, what does that mean in terms of their interest expense cost? This chart shows what it is as a percentage. See, 2024 is not really an issue. For 2024, it adds an extra 2% to their P&L. But look at the jump to 2025 and then even more to 26. This is a big slug of their P&L. This really matters. I think this is what the Fed has got its eye on. I think it's trying to line up some sort of remedy for these guys. Why? Because in the US, if you take all the publicly listed firms by their profit margins, nearly 50% are in negative profit, from negative to very negative. 50%. So if there's no remedy for these guys, what's going to happen? It's going to have an impact on the job market because they're going to lay people off. Historically, the evidence shows that they cut into labor and they cut into capex. Both are bad for the economy. You are sure as hell talking recession. I think this is what the Fed is looking at. And I think they've kickstarted with a big number yesterday for that reason. Theo, you and I were talking about this one because, just earlier, right? You had a specifically, this is a really fascinating, I mean, please go ahead. Sorry, I've gone and just jumped in here, but you had a specific question around it.
So yeah, I guess we have seen the 50 bips cut, but that's definitely not the end of it.
No.
Personally, what I care more about is where do we see the trough in this cycle? We know the monetary policy goes in cycles. There will be ups and downs, and we probably have seen the peak in the most recent hiking cycle. And now we are entering into this easing again. But do we potentially see the same type of trough as before? Let's say zero interest rate environment. That was a little too much too, right?
Yeah.
And I think we all agree the inflationary environment that we are in today is slightly different or largely different from 5 years ago.
Yeah.
Therefore, that might justify a higher low for the trough of this cycle. So where do you see the future low in the next 5 years in terms of Fed fund rate?
So for me, the figure is actually 3%, which coincides with this thing that they call the R star. So, as we both know, that's deemed the equilibrium rate, where you can match, where the employment side of the economy is matched with the growth side of the economy. And mine is based very simply on what I said earlier, which is that in order to provide support for the corporate sector, that corporate maturing wall of debt, they've got to do about 2%'s worth of work in terms of cutting. Now, how they do that is going to be a bit of a mystery, because the methodology behind it is what sends a signal to the market. If they do it quickly, then the market thinks, oh, wow, the Fed is really serious here. On the basis that they need to get a sizable amount done by at least the middle of next year. then I find it quite interesting that these predicted numbers representing the amount by which the Fed cuts. So let me just explain this chart. The solid line represents what the Fed has actually done to date. And down here, you can remember, these are the big increases that we had. In fact, if you go back further, we've got a couple of 50 basis point increases. Yesterday, this became a solid number, and it was a reduction by 50 basis points. So what this is saying, again, going back to that bookie scenario, the gambling scenario, is saying that based on what the Fed futures is pricing, if the Fed was to follow suit, it would cut rates by these amounts here periodically over that period of time based on the chart that is shown. Now, in reality, the Fed never does that. It does it in round numbers of 25 basis points. But if it was to follow it, that's what it would do. So what they've done yesterday is to cut it by 50 basis points. So effectively, they've done the full 30 there, and they've done half of the 34 here, more or less. So that's one under their belt. And the statement issued yesterday is that 10 out of 19 of the voting this is the what they call the dot plot. That's everyone's view of what they think is going to happen. 10 out of 19 of the voting members want a further 50 basis points, 0.5% of cuts by year end. And the other 9 out of 19 want just 0.25% by year end. And for next year, the whole of next year, it's a whole 1%. I don't know how they're going to do it, but I think how they go about doing it is what's going to send a signal to the markets. But 2% is what I think is coming. I think we're going to have another couple of 0.5% cuts along the way. Powell was very quick to point out that, he doesn't expect to keep cutting this fast. Well, okay, fair enough. I think there is at least 0.5% to come. It won't be this year necessarily. But I think he'll slot that in next year, Q1, possibly another one in Q2. But in between and around that, there'll be some 0.25 cuts. But I think he's got to get to 1.5 to 2% lower from where he is today. So 3% for me is the neutral rate. That's where we're headed to.
Now that's good to know, because I think what's important is so far we have been primarily focusing on the U.S., right? Although BOE and ECB had already made their moves, we all have our eyes on the Fed, primarily because it doesn't just impact the U.S. It actually impacts the entire global economy. And we do know that there are also some of the other economies who are actually in a contrary monetary policy cycle, who are not cutting rates, but continue to hike rates. There are also economies like China, for example, who have been in an extreme easing cycle and it hasn't come out of yet. So what do you see as the major impact of this move, together with some of the future moves that you just anticipated on the other economies?
Yeah. Okay. So if we take, it's like the twin engine planes, right? Two engines on both sides. So we've covered the US. The other three big engines are Japan, China, and Europe. Let's just look at Japan for a moment, because it's very much a story about the yen versus, well, here I've shown the yen dollar, but it's also the cross rates as well, the yen euro, yen everything else. Historically, if you look at Japan, its exchange rate has always been, give or take, about somewhere between 100 and 110. What we've seen lately is some pretty violent action in the yen. And for as long as I can remember, people have always borrowed the yen to fund risk on. And what we had during this period, even if I drew this even further back, it was a wonderfully cheap currency to borrow in order to finance risk-on plays. So on the right there, that table shows typical bank lending rates to corporates. And you can see cheapest of the lot out of this G20 list is Japan, 1.7%. So just to explain what this means, that means an investor, a speculator, who feels bullish about world markets, let's say they really fancy their chances on the tech sector, they can go and borrow yen at a paltry rate of 1.7%. They borrow that, they then convert it into dollars in the spot market, and they use those dollars to invest in, let's say, Nvidia and a whole bag of other, Mag 7 type stocks. And hopefully they'll get a big gain out of it. By selling the yen goes down. And by buying dollars, the dollar goes up. But every time you have a problem, they have to do the reverse. So now imagine that chain being unwound. They have to sell the dollars in order to make available the yen so that they can repay the loan. And that's what drives the pricing of the yen. People often say that, how come Japan, I've heard this said many times, Japan's not, its economy is okay, but it's hardly sort of like the darling of the world. And yet their currency seems so stable. It's because the thing that's driving their currency actually has almost nothing to do with what's going on in terms of the fundamentals. And I think the issue with Japan now is that traditionally, because it was always a major exporter, they liked a weak yen. They didn't want to let the yen get too strong because it helped their exporters. But the problem now is inflation. Because if you look at the right, and in fact, I've just the axes are the wrong way around here. So if you look at core inflation, which is on the left-hand side, it's the purple line. It's currently at around there. So that's about, give or take 1% year on year. That's what's happening in Japan. And it's come about because of the wages side. Wages have been going up, even though there's been some mellowing lately. Wages are going up at around, give or take, 4.5% per annum. So you've got real growth there, but people are feeling the pinch of inflation because when you have a weak yen, you're importing higher prices. And what has been the response of the Japanese government? Hardly anything. Look at the yield curve here. It's still languishing right down here at the bottom. Now, some are saying it's missed the boat. I don't know. I honestly, I struggle with this one, but I think Japan has to be extremely mindful that it can't just go jacking up interest rates to make it on par with the rest of the world. I was actually quite surprised to read. I was just Googling to see what percentage of manufacturing, accounts for Japanese GDP, and the figure is now down to about 20%. It's come down a long way. So I do believe that the Japanese government is about to raise rates. But I think, obviously they've got political issues now because the prime minister's out and the new one's going to come in. So they've got to get all that stuff sorted out first. But I think they are trying to move towards higher rates, but they're gonna be behind the markets for quite some time. So
Sorry to
that, yeah,
interrupt.
sure, yeah.
I think you've already touched on yen, the carry trade that people were so used to for many, many years.
Mm,
I'm even sure some of our friends at SWM probably have clients who've done carry trades in the past too.
mm,
Many of them got hurt badly in the most recent quick
yeah.
shift of the yen rate. So can I ask you two very quick questions related to Japan? One is that where do you see yen going for the next, let's say, 6-12 months? Um, just following that
Hmm.
chart that you are drawing on. And two, I think, again, back in the early years, we had the three arrows when all of the foreign interest suddenly piled on to Japanese assets, including bonds and equities, but particularly equities. That faded after a while. Now, it got reignited in the past year or two.
Hmm.
Many people are reading on the news headlines that, oh, Berkshire Hathaway is buying two large Japanese conglomerates.
Mm.
Maybe we should follow them too. So, how do you see the opportunities in Japan assets?
Yeah. Um, so I like it. So if we strip the two, you've got obviously the capital appreciation side in terms of the assets, which I do like. For the first time ever, I do believe in the whole, governance story. I do think it's actually playing out properly now, and I think that's a generational dynamic as well that's coming into play. I think it's almost a point of no return now for Japan, given their demographics. Um, from a currency perspective, I think we're going to see more of this range trading for some time. And I think that range there of 140 to 160, which is a wide range, will continue. I don't think the Japanese government's going to be in a hurry to try and manipulate rates. I do think that they will. I mean, I read somewhere that they're looking at possibly they might do two 25 basis point or 0.25% hikes next year. That's how steady it's going to be. Overall, I think the trend is for the yen to steadily get stronger, but I'm not holding my breath. I don't think that this is going to happen overnight. That's for sure. So, in other words, if somebody wants to go in for the yen depreciation story, as I once believed in quite strongly, I I've kind of changed my view a bit on that. I think it's going to be a long played out one.
Thanks.
So, yeah, if we just look at other parts, Europe obviously always a fascinating one. So, Europe again has done a tremendous job in terms of inflation coming down. Wages also are moderating now, but still very respectable. I mean, in real terms, that's impressive. Uh, Europeans are not poor, that's for sure. If you look at the status of their household savings rate, impressive. It's very impressive. As a percentage of their disposable incomes, they are saving at a rate of around 15%, 15 plus percent. And I had a look at the breakdown of that, and the big powerhouse economies are all in that kind of ballpark. I think Belgium led the way, actually, if I'm not mistaken. Last but not least, this is where the problem is. I think it's a confidence issue, perhaps a bit like China. The private consumption component is is non-existent. That's what's dragging it back. And when you delve deeper into that, there's one country that's distorting the picture. It's Germany. Because you look at all the other, I mean, okay, UK is not part of the euro, but in terms of the European plate, that's positive, and so far, holding up very well indeed. I mean, it's actually for once looking very positive. France is positive, Spain is positive, Italy is positive, but Germany is the big drag. And by any metric, Germany accounts for about 20 to 25% of any indicator, whether it's GDP, whether it's the activity indicators that I showed earlier. It is a big slug of the European component. And when you look at what Germany has had to face, these are some acute problems. Their manufacturing has been impacted. A lot of that ties in with China. There's obviously this huge trade dispute going on, and the accusations of Chinese dumping of goods. Prior to that, you had the whole Russia-Ukraine side. You've got the usual tariff stuff. This is where the US election matters so much. Um, You've got the demographic challenges. I mean, under Merkel, they let in something like 1.5 million Syrian refugees. Now you've got Ukrainian refugees who have gone in. The population has expanded massively to the extent that it's distorted their employment picture. Similarities to the US, actually, just not on a very different scale. And last but not least, now you've got political uncertainty.
Mm.
Have a look at the next slide. This is actually really concerning. So as far as the European Parliament goes, here's the outgoing Parliament, and here's the new Parliament. Look at the portion of the far right. It's massive. It's like 1/3 of the new constitution. So these guys, and if you look at the common characteristics of the individual parties within that, you've got the French National Front, you've got the German far right, and so on. They have a much softer stance to Putin. They have issues around the EU, although interestingly, none of them want to still leave the EU, but they want to bend and change the rules. In there, you've got the Italian side of life. Now look at the German state elections that we had about 2-3 weeks ago. And this was a devastating blow for the ruling party. The far right, the AfD, the Alternative for Germany, in the state of Thuringia, won 1/3 of the vote. And in Saxony, another significant state, not far off, over 30%. So it's a really different picture. But the far left also has been gaining, but nothing on the same scale. And these guys have made it very clear where they stand in terms of the politics. So I think this is a manifestation of the problems facing Olaf Scholz's
Mm.
government. They're missing that Angela Merkel style leadership, as we in the UK do when it comes to the late Margaret Thatcher. This is what's that's gone out of the whole picture.
But can I stop you on
Mm,
Europe for a little bit?
yeah,
Because it seems that your concern is still primarily around Germany, right?
yeah,
You mentioned you were bullish on UK and
hmm
some of the other European countries. But what surprised me was earlier this month, Mario Draghi launched this European competitiveness report,
right,
which is a lot more downbeats than what you just said.
yeah, yeah, it
But
is,
Draghi was forecasting that they're gonna putting billions, if not trillions, of dollars into R&D,
mm,
into ensuring future European competitiveness.
mm,
Is, but those amount of money is just not there.
no,
I mean, Draghi has this outlook that you know what, we need to be able to compete with US and China in the next decades to come. And the precondition of that competitiveness is that we need to pour in a lot of money. Unfortunately, European doesn't have that money. So do
mm,
you think you are a little bit more optimistic than he is, or what supports your
yeah.
optimism?
So his comments are spot on. I think at an infrastructure, at a governmental infrastructure level, he's spot on. I think he came up with a figure of something like 800 billion euros, as that needs to be done, and this is across, as you said, technology, roads, trains, defense, even and piling into that. Um, my optimism around Europe comes in different ways. First of all, when I look at the state of the European consumer, um, it's very easy to assume that the bad press we hear about Europe implies that the consumer is about to fall off a cliff. That simply isn't the case to me. I've looked at, I haven't included it here, but I've looked at the shape and state of European household finances, and honestly, they're very respectable. There's nothing wrong with them. And when they're saving at the rate of 15%, they need to, they've got money to deploy. Um, the second thing is, the irony is that for everything I've said about Germany, the DAX has been one of the best performers, right, in the European market. I think at the last count, it was up something like 11% on the year
Mm.
in local money terms. So German companies are operating very efficiently. I just think they could do a lot better, as indeed, and consumers would feel a lot more confident if Europe got its act together. I think Europe hasn't reinvented itself ever since the EU was formed, and it's been many, many years now. Um, so I see all that as upside, but it won't come overnight. And I think what the far right election does is to expedite it. Because one thing those guys don't want to do is to leave the euro or indeed leave Europe. So much so that
Mm,
Marine Le Pen's National Front movement, was losing in previous elections because of her stance on Europe. Now even she's had to change it. Same goes for Giorgia Meloni in Italy. And it
yeah,
will also be the case for the alternative for Germany. So they have to work within the framework. But I think now you're getting to a point where these guys can actually do something. And it might not even be them that need to do it. Macron's really messed it up in France. He's going to be out by 27 or whatever the year is. He took a chance, and in my opinion, it failed miserably. So I think there's this impetus coming. Meanwhile, Europe is so cheap that it's not a basket case. That's where my optimism still remains for Europe.
that's good news for many of us on the call.
Yeah.
Thank you, James.
Okay. China. So this one will obviously, I'm very curious what you think here. I've tried to take a different view. So, and I came across an article which really resonated with me in terms of how the West sees life, how possibly China sees life. Um, and this summed up many aspects of what I've been thinking here. Um, I think first of all, President Xi, he's walking a bit of a tightrope. There's no doubt he's walking a bit of a tightrope here. I think part of him obviously wants to make damn sure that the Chinese consumer doesn't collapse. And clearly there's that correlation with the property market and so on and so on. So he will do anything and everything that he needs to do in order to keep it propped up. It must be concerning to him that even the measures they've taken have had quite sort of tepid results. That's something that definitely he will be under pressure about. And you always hear these rumors about what's going on internally. But outside of that, obviously, he has this desire, or one can call it a sort of nationalist desire, to compete with the West, particularly America. Um, and I've sort of summed it up at the bottom there in bold. He really wants to invest in technology and set up the China of the future. Um, so that investment, be it the space race, AI, robotics, military, etc., um, is is necessary, but it also doesn't address the issues about the consumer. And this is the balance that he has to find. I'm guessing, because I certainly don't think he's got his eye off the ball, I'm guessing that he thinks there's just about enough growth keeping China ticking along at a consumption level um, so that it doesn't fall off a cliff whilst he can pursue this side of life. And he certainly doesn't believe in handouts. So whereas, we know that the US consumer will spend. I mean, we saw that with COVID, vast amounts, and that cash pile kept them going for a good couple of years. Because we just know that the American consumer will spend. And that's what the Americans want. In the case of the Asian investor, it's a different mindset. And I think he must see this as a waste of money. So the priorities for him, if you look at that chart on the left, is very much around still investing in the manufacturing side of life, which is feeding the whole technology, the solar, the electric vehicles, batteries, etc., and also with it the fixed asset investments that are necessary. Real estate clearly is a dismal picture, but I still think that this is something that can be supported, but he would rather that the state governments handle this and sorted themselves out. That's how I see it. What it means for us in the West generally are two things. One is that China's going to take longer than we thought, but it will turn the corner. It definitely will, and I certainly don't think it's years. Um, and secondly, this also comes down to US elections. It could take even longer if Trump wins, because sure as hell he will slam on additional tariffs. And if you
Mm,
look at the export section, that's right now uh, bringing in some money for them. I mean, it's gone from negative to positive. They need that. They need to keep widening. We've seen these initiatives with African countries. I think that's one engine that it needs to keep going. So that's how I look at China. Curious what you think, though.
No, thanks, Javier. I think I echo your comment on German companies just now. Many
Mm,
of the German companies are actually doing well. I think the same applies to many Chinese companies. The Chinese economy can be doing well or not doing so well, but that doesn't prevent many Chinese companies to be performing very well. And I'm very happy to expand on that. But I'm aware that we are kind of running short of time,
yeah,
and I don't want to miss some of our guests' questions. So I'll read out two of them to you.
yeah.
One is from Joseph. You said 50% of the S&P companies are showing negative profitability.
Mm.
Does this rate, the most recent rate cuts, embolden them to pack on more debt and further increasing the 2025, 2026 maturing debt risk for those companies?
I think it's certainly the first step in mitigating the higher interest rate cost risk, which is the first thing that the Fed really needs to address. That's my view on this, and I think that's been one of the main drivers. So by helping them to roll that over, it stops it from getting worse. That's the top priority there.
Yeah, I tend to agree. So I think overall default rates of high yield US corporate is still very low compared to historic levels. No doubt it will go higher, but I don't think it will go too much higher. So in the near term, I would rather suggest investors' concern should still be more on US Treasury rather than US corporates. Ironically, I guess again this is similar to Jabez's comment on German companies and what I was saying about Chinese companies. I think overall, actually, U.S. companies are probably doing better than the country itself.
Mm,
The next
yeah,
question
yeah.
is from Kieran Donovan. We've seen markets perform very well back at the end of last year when there was this anticipation about rate cuts taking place in 2024 as it added euphoria into the markets. Now that the Fed and BOE finally cut the rates, are you expecting the market to perform well in the short term, say towards the end of this year? Or are you expecting this rate cuts actually taking place to be a negative?
Right. Okay. Yeah, that's a great. Let me fast forward then to this. It's actually my last slide, and it's just some themes that I think present themselves right now. Um, so I think between now and the election, which is going to be incredibly tight in America, um, I think markets will certainly do very well on the back of that. What the Fed has done is to avoid a slide in markets by essentially giving people what they want, albeit for different reasons. So certainly in the short term, I think that's definitely very healthy for markets. I think when reality sets in, and this is a question of who comes into power. If Kamala Harris wins, then I think
Mm.
going into next year, at some point, invariably, when people realize that rates will never go back to as low as they were. If I'm right about the R star, and it is around, let's say, 3.5, closer to 3, then I think people will start to realize that the cost of funding is always going to remain higher than the luxurious state that they had before. That will create some volatility. If Trump wins, I think not only is that going to be an issue, but inflation also becomes an issue. You'll see in my themes there that I'm very much into having protection there, commodities. Even though oil prices have sold off, I think global demand will start to pick up again. So you'll see a repeat pattern. It won't be history won't repeat itself, but it'll have show signs of rhyming with what's happened in the past, but it just won't reach the same level that we've had before.
Well, this is phenomenal. Thank you so much. I think our discussion today is very timely. Hopefully, this has offered you guys some idea for the trading for clients and positioning of portfolios in the next quarter or two. of course, we will come back with a very similar um, webinars in the following quarters, and you are more than welcome to join us. I note there is another Q&A. Jeb, can you see that?
Um,
Uh,
no.
let me. Yeah, I think we have covered them all. So no, that's great. Thank
Okay.
you all very much. There is a hand raised. Ross, can we unmute the audience so that they can ask on the call? Okay, I think we are done for today. Thank you very much for attendance. As I said, there will be more to come. We look forward to seeing you on similar webinars in the future.
Okay. Thanks, everyone. Thank you very much. Thank you, Thea.